At Insightful Value, we dig for gems in beaten-down names. And today we're peering into Acadian Timber, whose stock has slipped hard. This review is for informational and educational purposes only, not financial advice. If you enjoy this kind of deep dive, hit like, subscribe, and drop your thoughts in the comments. Let's jump in. Acadian Timber, TSX, ADN, is a timberland and forest products company operating in eastern Canada, New Brunswick, and in Maine, U.S. They manage roughly 2.4 million acres, including about 1.1 million acres of freehold lands. Their business includes harvesting and selling softwood and hardwood sawlogs, pulpwood, and biomass byproducts. They also generate revenues from voluntary carbon credit sales, in 2024, approximately $24.6 million, as part of diversification. In 2024, Acadian delivered sales of 116.2 million Canadian dollars, up from approximately 93.5 million Canadian dollars prior year. Adjusted EBITDA jumped to 38.9 million Canadian dollars versus 20.6 million Canadian dollars in 2023, giving an improved margin of approximately 33% versus approximately 22%. Free cash flow was 29.7 million Canadian dollars. However, net income fell. In 2024, they reported 21.7 million Canadian dollars, $1.24 per share, versus 29.4 million Canadian dollars in 2023. In more recent quarters, revenues have shrunk. Trailing 12-month revenue is 88.15 million Canadian dollars, 26.8% year over year, and Q3 2024 saw softer performance. Adjusted EBITDA was approximately $4 million, free cash flow approximately $2.5 million, and they paid a Canadian dollars 0.29 per share dividend. From a value lens, Acadian shows gross margin approximately 27.8%, operating margin approximately 15%, profit margin approximately 16%, based on recent data. On the balance sheet, they carry debt of approximately 110.7 million Canadian dollars against shareholder equity, approximately 336.8 million Canadian dollars, giving a debt-to-equity ratio of approximately 32.9%. Interest coverage is moderate, approximately 4.1 times, and cash on hand is modest, approximately 2.65 million Canadian dollars. They pay a quarterly dividend of 29 Canadian cents per share, total approximately $1.16 per year, giving a yield around 7%. But that payout is not fully covered by earnings. The payout ratio is over 100%, meaning the dividend exceeds net income, raising sustainability concerns. Risks include depressed demand and weak pricing in lumber and wood markets, increased harvesting and transport costs, volatility in carbon credit prices, the strain on dividend coverage, and sensitivity to macroeconomic cycles. Tariff uncertainty and weakening statutory earnings are flagged by analysts. Why might one consider it now? The stock is trading at a new 52-week low, declining 16.19 intraday. PE is relatively modest, in the neighborhood of approximately 20 times to 22 times, and the high dividend yield could entice income-seeking investors. If forestry demand recovers, pricing stabilizes, and carbon business scales, there is upside. But the margin for error is small. Why not invest now? The weak revenue trends, shrinking profits, and unsustainable payout ratio might drive further downside. At Insightful Value, we deliver in-depth, jargon-free breakdowns of undervalued names so you can see the story beneath the numbers. For more on Acadian Timber and dozens of other underappreciated companies, check out insightfulvalue.com. Thanks for watching. Don't forget to subscribe, like, and head to insightfulvalue.com for more deep dives.